I am Barry Brooksby, and I want to show you how you can triple your real estate returns with infinite banking. Infinite banking uses a properly structured high cash value whole life insurance policy and allows you to take policy loans against the cash value. And check this out. When you take a policy loan from your infinite banking whole life policy, the insurance company doesn't physically remove that money from your cash value. So you can go buy real estate and you're still earning interest and dividends on your total cash value in the policy. It's remarkable. I'm a 17-year real estate investor. I use my policies to buy real estate. Watch the video. Let me show you exactly how you can triple or quadruple your real estate returns using an infinite banking policy. You're going to see I start off first with correct financial principles. Check out the video. And if you would like to see your own numbers, reach out to me. And I encourage you to learn as much as you can about infinite banking. You can watch my other infinite banking webinars. Check out the video here.
Rich Dad, Poor Dad by Robert Kiyosaki. I've recommended it probably over 1,000 times, probably more than that. This book, although it's real estate based, which is good, it teaches financial principles. And to me, that's even more empowering than the real estate itself. You know, Robert talks about it's not about the money you make, it's about the money you keep. That's one of the principles that he teaches. He also teaches about paying yourself first, that when you make money, you should pay yourself first. And another principle he teaches is assets versus liabilities. And so I have a quote here by him, invest in assets. And when we invest in assets, from his perspective, we want to invest in assets that generate cash flow. So a lot of people believe that the home they're living in today is an asset. And it could be considered an asset. It's tangible. But the home you live in today is not producing cash flow. It's taking cash flow. You've either paid cash for your house or you're making a mortgage payment. And so it's like a liability from that perspective. So when we think about cash flow truly, we want to think about assets that produce cash flow, which could be a business, could be real estate, could be a royalty deal, it could be intellectual property. There's a number of things out there that we could talk about that produce cash flow. But in this case, real estate producing cash flow. What we're going to do here is we're going to make a comparison and get this idea between a cash investment and another type of investment that I'll get to in a minute. So this house on the left, we're going to say that the person that buys this house is going to pay cash for the house. So this is an example, a real deal that we're going to walk through and learn from. So this property, the purchase price on this house is $150,000. PP for purchase price. And this person has saved all this money. 150 grand's taken several years to build up. They're going to go out and buy this property cash only. And the property is going to rent for $1,200 a month, which would equal $14,400 a year. Well, $14,400 per year is the cash flow that's being generated from a $150,000 investment. Now, the first thing that I want to teach is this term called cash on cash. It's a cash on cash rate of return. When we look at a cash on cash rate of return, we look at the amount of money that we're earning in rents, and then we divide that by the cash that we've put into the property. So in this case, if I take the $14,400 and divide it by the $150,000 that was put into the property to buy it, it's a 9.6% rate of return. So I want you to remember that. We'll write it down here. 9.6% rate of return. This is cash on cash. You notice I'm not taking out any expenses right now. I want to keep this really simple for our purposes tonight. But yeah, there might be some maintenance costs, some property tax, insurance. This 9.6% rate of return would be a gross cash on cash rate of return. What I've learned from real estate and Robert's book and other real estate gurus out there is that using our own cash really isn't the best thing to do. We want to talk about leverage. I did a webinar 2 months ago where we talked about the 4 pillars of wealth. You can go back and watch that webinar. One of the pillars of wealth is leverage. How do we create more wealth? We use leverage. We use other people's money. What if in this case, instead of coming in with a full $150,000 of out-of-pocket cash, the investor now decides, you know what, same purchase price, but instead, I'm going to ask a bank to give me a mortgage for $120,000, which is 80% of value. So there's the mortgage. And I'm only going to come out of pocket with 20% down, which would be 30 grand. This is our down payment. Now we're leveraging. Well, the issue we run into here is that when we have a mortgage, there's now a payment associated with the mortgage. So let's look at that. The rent isn't going to change. It's the same $1,200 a month or $14,400 a year. But let's look at what this mortgage does. So I'm going to grab a loan analysis calculator. In the left-hand corner it says loan analysis, and I'm going to type in the $120,000 mortgage. So this is an amortization schedule, essentially. We can analyze what the amount of the payment will be. And I'm going to use a loan rate of 6% because we're looking at this like an investment property. And we're going to amortize this over 360 months, which is 30 years. So if we look at the amortization schedule over that time frame, we see a payment of $720 here. It's $719.46. We'll round to $720 to keep the math simple. Now, when you're purchasing real estate as an investment property, different banks or different credit unions, different lenders have different rules. Some might say, yeah, we'll amortize over 360 months to lower your payment, but it's really a 10-year loan or a 20-year loan. If we did the math on this, let's say they give you a 20-year loan, but it's amortized over 30 years, that means in 20 years at 240 months, they would want you to come in and pay off this $64,000 loan balance as a balloon payment. Again, different banks have different rules. Tonight, I'm just keeping it really simple, 360 months of amortization for $720. So what that means is we have to take the $720 out of the monthly rental. So $720 in a payment now is going to leave us $480 a month, which equals, let's do the math on this, just so you can all see what I'm doing, $1,200 minus $720, which is the mortgage payment going back to the bank. But remember, now you have a tenant paying essentially your mortgage for you. And this mortgage payment of $720 a month is reducing both the principal balance of the loan and paying the interest. Every time that $720 a month is paid, what's happening is the balance of the loan is going down. And because the balance of the loan is going down, so also is the amount of interest that you're being charged every month, which is great because, again, your tenant is paying for that. It's another great thing about real estate. Getting back to that calculator, 720, there's our 480. We times that by 12 months, which now gives us $5,760 of annual income. So we'll say a year. Obviously, this 5760 for the same house is less cash flow to you than the 14,400. But here's where it gets fun. Remember, on the cash deal, you came out of pocket with $150,000. And that gave us a 9.6% cash on cash rate of return. However, with the leverage deal, you only came out of pocket $30,000. So now if we do the math, with our cash on cash rate of return, we take our 5760 per year and we divide it by the 30,000. Again, that's what we came out of pocket with. And that gives us a 19.2% cash on cash rate of return. So let me write this out. 19.2% ROR versus a 9.6% rate of return. You've used other people's money, you've leveraged, you've increased your rate of return. Although the net rent is lower at $57.60, you've increased your rate of return. Now, we're not done. As awesome as that is, doesn't this person that had the $150,000 of cash still have money left over? He's still sitting on $120,000. So what that means is he could go out and purchase more houses, 4 more exactly. So let's take a look at that. Let's put another house over here, another house over here, another house over here, one more over here. For the same $150,000 that the cash investor was putting into one home, that exact same dollar amount with a $30,000 down payment can now purchase 5 rental properties. The rate of return will stay exactly the same, 19.2%. But check this out. We now take the 5760, that's annual income after we make the mortgage payment per house, so we're going to times it by 5. So with the same $150,000, not only did we increase the rate of return to 19.2%, but the cash coming in, $28,800. It's double the amount of income and the same amount of money out of pocket. Leverage is extremely powerful. Some people fear leverage. I get that because they look at it like debt, right? There's going to be a lot of debt on 5 properties. We have to be cautious, right? We want to make sure that we're safe as we get into these properties and we're not leveraging too much. So when we're thinking about leverage, we want to consider a few things. Number one, smart debt is when you are cash flowing on your property. If I was showing this property to you and the rent was $1,200 and the mortgage was $1,500 and I'm coming out of pocket $300 every month to pay it, that's probably not a smart investment. We're going to get to rules to live by here at the end, but we want to think about this from a smart investor perspective. What it comes down to, as Robert Kiyosaki said, is cash flow. We want to make sure that we cash flow on the properties. All right, I'm going to come back to this truth concepts calculator. Now, what I've done here, I've preloaded the information that we just went through. So I've preloaded the price of the property, and to be fair, I'm using the same value as the price. So we see up here in the left-hand corner, the property value is $150,000 and the price of the property is also $150,000. Now, normally I wouldn't buy a property for the value of the property. I would want to get a deal on it. But in this case, I'm trying to be fair to keep the analysis really legit. So we have $150,000. We took out the loan with the bank for $120,000. There's our 6%, 360 months. I use 720 as a payment. And here's our 19.2% rate of return. Now remember what I said earlier on the whiteboard here was these are gross rate of returns. This one is kind of gross because I'm taking out the mortgage payment, but I'm not taking out taxes, insurance, maintenance. I'm not taking any of that out, but we're going to now. Because again, I want to be real about this. And when you get into real estate, you want to know your numbers. You want to know what's the gross cash on cash rate of return and what's the net cash on cash rate of return. And that's what we're going to discover here. We're going to go ahead and say the property taxes on this are $100 a month. These are monthly expenses. We'll say the insurance on this property is $50 a month, and we'll go for maintenance at another $50 a month. So look what that did to the rate of return. We've dropped now to about 11% on the rate of return. And by the way, I'm not showing any appreciation on this property either, which probably isn't accurate. If you're a true real estate investor, the gurus are wanting appreciation as well as income. But I'm trying to be conservative. If I put in 3% here, you can see the rate of return is awesome, brings up that cash on cash rate of return. But I'm going to go back to 0 for the property appreciation. So an 11% net cash on cash rate of return. That's where we're sitting right now. And because of those expenses, you see the monthly income either in this column here or this column here is now $281. Okay, so it reduced our $480 that we had over here down to $280. The concept that I want to share here, number one, to clarify, we now have adjusted this to show a net cash on cash rate of return. But we want to take it one step further. If you're going to spend $150,000 on real estate, either to go buy it with cash or to do what I showed with leverage and buy 5 properties, where is that money sitting? If you know that you have to have that money liquid to be able to use for real estate, where is it sitting? Maybe I should ask, where is it not sitting? It's probably not sitting in the stock market, right? Because it's going to be volatile. It's probably not sitting in your 401k or IRA. It's probably not sitting in mutual funds. It's probably not sitting in a CD because most CDs have a time frame where the money's locked up for 2, 3, 4, 5, 10 years. This money's probably sitting in your bank account. And if it's sitting in your bank account, it's probably earning a 0% return, but it's liquid. And I say 0 kind of facetiously. I know maybe it's earning 0.02%, right? But the point is it's very close to 0 these days. That's okay because we want the money liquid. We want it available. But as many of you know, there's a better place to put this cash that still is liquid, that still is guaranteed, that's still protected like a savings account. And one other benefit that we don't get from savings, it's also tax-free. And that is a cash value insurance policy. So with a cash value insurance policy, we can be storing that same $150,000 over here, earning 4 to 5% completely tax-free. Much better than 0, because a 4 to 5% tax-free return, depending on your tax bracket, is really like earning 10 to 12% in the stock market. Well, let me show you what we do with this. And next month, we're going to dive more into this, how to coordinate tax-free money with real estate to explode your returns and your income even greater. But let's run with this a little bit further. Because as I look at the calculator and I say, I've got this cash value insurance policy. What can I do with the money? Rather than coming out of pocket for 30 grand, what if you took a loan from your cash value policy? I'm going to do two things here. The first thing I'm going to do is make a little adjustment. Let's make the adjustment as if there were, say, $4,000 of closing costs that we came out of pocket with too. Some lenders will let you roll those into the loan. Other times the seller might take care of those. Every deal is a little different. But let's say you come out of pocket with the $4,000. So now your total down payment over here is $34,000, which brings your net cash on cash rate of return down to 7.71%. How do we increase the rate of return? We take a policy loan from our cash value policy. Instead of the full $34,000 coming out of your own pocket,
We'll use our infinite banking plan.
our cash value policy is collateral, and use $30,000 over here as a second mortgage to increase our return. Watch what happens. When I put the $30,000 in here as a policy loan on this real estate deal, watch the 7.71% jump to 26%. That's a net cash on cash rate of return of 26%. Why? Because you only came out of pocket truly with your own money, $4,000. That was it. And remember, I'll get into this next month more, when you take a loan from your cash value insurance policy, your full cash value is still earning interest and dividends. So although you have that money in the real estate deal, you're still making the 4 to 5% tax-free in the cash value insurance policy. Very powerful. Now, this is one example of many. We're going to go through another example next month. But here's what I want you to comprehend. It's the power of leverage. We're not leveraging here in just one way. We're leveraging in multiple ways to increase our returns and to make more money. I hope that this has been beneficial for you to see how to leverage, how to increase your returns, how to make more money in real estate. The infinite banking concept is what you get. These are your benefits. Guaranteed money, liquid cash, protected in most states from creditors, lawsuits, bankruptcy, and tax-free use of your money. The best thing you can do when it comes to real estate is educate yourself. And the more you know, the less risk you take. The more you know, the more success you'll have.
If you've liked what you've seen here and you want to learn more and find out what's possible for you, click the button below to schedule a call. We'll meet, we'll talk about your goals, what you want to accomplish, and find out what's possible for you with infinite banking.
Thanks for being with me learning how to triple your real estate returns.
Great job attending the webinar, and I hope to talk with you soon.